Good morning, good afternoon to our audience members joining us from across the globe. I'm Raymond Karam, the Chief Program and Development Officer here at AGSIW. We're truly delighted to be partnering again today with our esteemed colleagues at the International Monetary Fund on the launch of their policy paper titled Economic Prospects and Policy Changes for the GCC Countries 2021. In case you haven't seen it yet, I will share a link to the paper in the chat with you all shortly. And since we only have an hour for this program, I'll introduce our speakers very briefly here, and you can find their full bios on our events page at agsiw.org. First, I'd like to welcome Erik Lundback, the lead author of the IMF paper, Economic Prospects and Policy Challenges for the GCC Countries 2021. He's a senior economist and lead desk for Saudi Arabia in the International Monetary Fund's Middle East and Central Asia Department. His previous assignments at the IMF include leading financial sector assessment program and capacity development missions in the Monetary and Capital Markets Department, as well as country surveillance work on various economies, including Nigeria, Portugal, and Switzerland. I'm also happy to welcome back our good friend Malik, the chief economist at Abu Dhabi Commercial Bank, where she works on building economic research to help inform the bank's decision making. She has over 20 years of experience as an economist in the Middle East and North Africa, and is the author of several academic books and articles on economic development in the Gulf Arab countries. Moderating the session today is AGSIW Senior Resident Scholar Robert Mogielnicki. He's a specialist in the political economy of the Middle East and North Africa and leads the Next Gen Gulf series, examining technology trend in the Gulf Arab states. He also teaches a graduate level seminar on China, Middle East, and North Africa relations as an adjunct assistant professor at Georgetown University's Walsh School of Foreign Service. And with that, Robert, over to you.
Great. Thank you, Raymond. And welcome back, everyone. As Raymond said, we held a similar event with the IMF in December of 2020, after a very trying year for Gulf Arab economies. Monica, thankfully, joined the program as well back in December of 2020 and helped us make sense of things. And we had Eric's colleague, Daniel. I took the liberty of reviewing my remarks and the event recording just in preparation for the program today, as well as, of course, going over the new report. And it struck me that a year and change ago, we were pretty optimistic about where things were heading, despite not being entirely out of the woods. And well, we're still not out of the woods entirely, but there are plenty of reasons to still be optimistic from an economic standpoint. Oil and gas prices are high and rising. Brent crude is pushing upward and starting the year at around $80 per barrel and now exceeding $90 per barrel. Those energy prices at that rate significantly reduce the fiscal burdens facing regional governments. And for the most part, governments have stuck with fiscal consolidation efforts. By way of example, Saudi Arabia expects more revenue in 2022 than in 2021, but they've cut expenditures year on year. So they're planning to enjoy their first fiscal surplus in quite some time. We're also seeing tax reforms continuing apace. I mean, certain taxes, the rates are going up with value-added tax, or new corporate taxes appear to be coming down the line as of the latest announcements in the UAE. And all of this makes new revenue streams available to governments. The UAE is also coming to the final leg of Expo, and I hope some of you on this call were able to make it out there. And Qatar is gearing up for the FIFA World Cup. So with these and many other economic developments that we don't have time to refer to in these opening remarks, one can really get a sense of economic momentum in the region, despite some fits and starts associated with coronavirus-related policies and restrictions. It would be naive, however, to think that all is good in the neighborhood, that the unprecedented disruptions related to the coronavirus would not pave the way for some longer-term challenges. GCC countries are at different stages of recovery, and certain segments of the population remain more vulnerable than others. Global trends also impact key sectors earmarked for economic diversification, with industries like tourism topping that list. And beyond keeping economies afloat and mitigating against the impact of future crises, regional governments need to produce many more employment opportunities for their citizens. So those are just a couple of headwinds as we look ahead. This leaves plenty of work to be done, but we only have an hour today. So let's turn to Erik first to give us some big picture findings and insights from this latest report by the IMF. Over to you, Erik.
Okay, thank you, Robert. And also thanks to the Arab Gulf States Institute in Washington for inviting me. And also a special thanks to Raymond for coordinating with me. And also I'm happy to see Monica joining for the discussion. So I want to say a few words about the key messages of the policy paper, Economic Prospect and Policy Challenges for the GCC countries. It was published in December last year, and it discusses recent economic development and policy challenges in the GCC. I will be very brief and focus on the big picture of the main findings of the report and also bring out what has happened since the report was finalized and published and how that may have changed some of the conclusions. It's barely 2 months, but it feels like it's been quite a lot going on since the report was published in December. And now I will just show a few slides on recent developments with respect to COVID economy and what challenges and vulnerabilities looks like, and have that serve as a backdrop for a few conclusions on policy priorities. So I'm going to try to share my screen here. Let's start with taking a look at the COVID developments. At the outset, swift policy action helped the GCC region to fight the pandemic. Policymakers moved quickly to mitigate the health and economic impact of the twin shocks from COVID-19 and the sharp oil price drop. As a result, infection rates declined across the GCC. However, there were setbacks, and countries to different degrees experienced successive waves of the virus also in 2021 following the outbreak in 2020. Now with Omicron, there is another wave of sharp spikes in infection rates across the region and the globe, of course, surpassing past peaks, although we expect and hope that it will improve relatively soon based on patterns in some other countries. And the cases in Qatar, Saudi Arabia, and UAE are actually seem to be declining somewhat already. On the bright side, vaccination is progressing well, and vaccination rates compare well with other regions, which bodes well for the future trajectory of infection rates, macrofinancial resilience, and the scope for economic recovery. In this connection, it's worth noting that death rates have thankfully not gone up that much with the Omicron wave of infection. And there has been some tightening of measures to fight COVID. Some countries have tightened a bit, but overall, stringency is lower than in the past. And measures of mobility have continued to trend upwards. And this includes indicators for grocery and retail shopping, recreational activity, and workplaces. So on the economic front, there have been positive developments overall. Certainly, this has been helped by good domestic policies and an improved global environment, including higher oil prices, and it seems that recoveries are beginning to take hold. Short-term indicators such as the PMI are on the upward trend, though, through end 2021, with a bit of a softening more recently, but they remain in expansionary territory, which is quite good given the Omicron surge. This is also reflected in GDP numbers. We currently estimate GCC's overall GDP growth to have been 2.5% in 2021, reaching 4.6% this year on projections that were made in mid-January. Cutting out the oil and gas sectors, we estimate 2021 non-oil GDP growth for the GCC to have been 4% and project it to be 3.4% this year. At the same time, we see that countries are in different phases of recovery with varied growth prospects and policy space. We have seen Saudi Arabia rebounding strongly since the second half of 2020, while other GCC countries experienced stronger second waves of virus outbreaks, which delayed their reopening schedules and economic recoveries. But right now, as I said, we project all GCC countries to see an acceleration in growth in 2022, also helped by increased oil production. However, countries do face risk of permanent output losses in the post-pandemic era for a variety of reasons, and projected GDP levels of the medium term through 2024 are now below what was projected before the pandemic, and that's an important point to remember. On inflation, which currently is a widespread concern in both advanced and emerging economies, we have seen inflation picking up also in the GCC. But this has so far been contained. CPI inflation is estimated at 2.7% in 2021. In 2022, inflation is expected to be relatively low as well, at around or below 3%, although there are upside risks given the exchange rate regimes, the pegged exchange rate regimes, I should say. So turning to public finances, favorable domestic and international conditions, including higher oil prices, are expected to have improved the GCC overall fiscal deficit from 9.2% to 1% of GDP in 2021. And as noted before, we expect it to turn into a surplus in 2022. This is reflected in public debt levels, which generally increased since 2019 before the pandemic, although they have started to decline. Here it deserves to be mentioned that public debt have been on an upward trend in the years before the pandemic, mainly as a reflection of countries not fully adjusting to lower oil prices during that period. At the same time, there are still substantial buffers, external buffers in most GCC countries in the form of foreign reserves and sovereign wealth fund assets. Higher oil prices also support economies and public finances, and it will be important for policymakers to use the windfall to shore up balance sheets and rebuild policy space. Where buffers are smaller, rebuilding those will be even more of a near-term policy priority. In the past, spending has been pro-cyclical. With higher oil prices, public spending has tended to go up, and this is a pattern that needs to be avoided to create a smoother and more predictable ride going forward. So, GCC countries need to do more to diversify the revenue base and put public debt on a firm downward path. While measures to diversify government resources have resumed, non-oil fiscal balances remain highly negative, and non-oil revenue as a share of total fiscal revenues have been around 1/3 in the last several years. So, of course, there is a positive picture, but it needs to be seen in the context of a highly uncertain future, both with respect to health developments and the macro financial environment. The global economic recovery is fragile, as we've seen quite lately. Despite progress in fighting the pandemic, including vaccination, there is an ongoing global resurgence, and future surges in COVID cases in the region or globally cannot be ruled out. The rebound in oil and gas prices has improved fiscal and external balances in the GCC. But oil and gas prices are, as always, uncertain and already expected to decline somewhat based on oil price futures. We furthermore expect oil demand to be weaker over the medium to longer term, as countries across the globe are taking measures to address climate change. Bottom line is that dependency on volatile oil prices remains a risk for the region. In addition, there are global concerns about inflation, which have not yet resulted in elevated inflation in the region, but there is clearly a risk. And importantly, global financial conditions may tighten as central banks start to normalize their monetary policy, which could reverse capital flows, drive sovereign spend higher, and squeeze public financing for some countries with more limited fiscal buffers and more reliance on external financing. In this context, I want to mention that the banking systems in the GCC appear sound, but vulnerability may emerge as fiscal and financial support measures are likely have masked some risks and build-up of balances, including the soundness of borrowers. So Then with this backdrop, GCC policymakers must continue to navigate a challenging and uncertain landscape. For the near term, policy priorities differ depending on the specific country circumstances, how much the recovery has developed, and how much policy space there is. But generally, support needs to be maintained while being increasingly targeted to hard-hit sectors and vulnerable groups to contain fiscal burdens and let economies adjust. When the pandemic subsides and economic recoveries are well established, policies should address medium and long-term challenges, which were made more pressing by the pandemic, with a view to achieve inclusive, sustainable, and broad-based growth. Key policy areas include fiscal sustainability, macro-financial stability and efficiency, climate change and the future of oil, and limit output losses and promote the economic diversification. So I do not have time to go through the various aspects of these policy areas, but we are discussing them at some length in the report that was just shared, and also in past reports where we discussed some of these issues. So we just continue and just have a brief conclusion of the main findings to finalize my remarks. So the region was hard hit by the COVID-19 pandemic and the negative shock to the oil market. The policy response was quick and strong, and there has been great progress since then. Economies are recovering even in the face of the Omicron resurgence, and vaccination rates are high. There's still significant risks and uncertainty both in the GCC and globally. This leaves the GCC countries with significant policy challenges, both near term and over the medium to long term. Near-term policy priorities vary across countries depending on economic strength and policy space. Generally, the short-term policy priority is to maintain support measures and also to have the support being more and more targeted. Soon there must be an increased focus on medium-term policies to secure fiscal sustainability and macro-financial stability, and to achieve strong, inclusive, and green growth for the future. Medium-term and long-run fiscal consolidation is needed to ensure fiscal sustainability. Continued structural reform are necessary to boost non-oil growth and employment, and to diversify away from oil. And vigilant financial oversight remains critical to maintain macro-financial stability. So I'm going to stop there. This is a quick summary.
Thank you, Erik, and appreciate you sticking to the agenda in a lot of time down to the second. So many thanks for that. I'm going to go to Monica now, and this is this space is your bread and butter as well, Monica, and you're thinking, writing, and speaking about these issues in addition to releasing reports as well on similar topics. So what are your reflections on this recent report, and any other insights you'd like to add that you think would be useful for our audience here today?
Thank you very much, Robert. Thank you, Erik. I think our views are very, very similar to the ones that Erik had put forward. I think the GCC countries have really managed the pandemic very, very well. Of course, there's the very high vaccination rate, some of the strongest globally. We've remained open. There's been variations in new restrictions, but really since the first pandemic lockdowns, social mobility has been quite open, even with variants such as Delta and Omicron. It's been more social distancing rather than new shutdowns and lockdowns. Actually, I had a colleague from another bank who's covered the GCC, who lives in the UK, and he came to visit me earlier on in the year, and he couldn't believe how open it is and how we haven't had lockdowns. But I think, also the fact that we have remained open, I think OPEC Plus members have also managed the oil situation very well and the rebalancing. And we're really now seeing the benefits of that. And Erik had talked about, the stronger output levels and the real oil sector growth. And I think, you're going to see a lot of GCC countries, the large producers, Saudi Arabia, UAE, and Kuwait, increasing their global oil output share at the moment as well. So I think it's that double combination. Of course, with oil at this level, the GCC countries enter 2022 in a very, very strong position. We also believe that on a consolidated level, there'll be a fiscal surplus, the first since 2014. And, across the board, our forecasts are based on still a relatively conservative oil price at $75 a barrel. But if oil prices at 90, we would see all the five countries of the GCC, barring Bahrain, seeing a surplus, in Bahrain with a very, very small deficit at that point, close to its budget break-even oil price. At 75, we see all of the countries except Oman and Bahrain. So very comfortable position. The other point that Erik had made is how we use the fiscal surpluses and how it should be used to build up buffers. And I think on the whole, that's exactly what's going to happen. I think there's a focus on not having very strong cyclical spending, which was the trend until 2014, that surpluses will be used to build up reserves, lower debt levels, and in the case, in some cases also support the transformation program, as in the case of Saudi Arabia, supporting the PIF, the National Development Fund as well. So, I think we're getting a balance where we're not having very, very sort of expansionary fiscal policy in response to the higher oil price, but we're going to see less headwinds from the fiscal side, a weaker need for austerity or spending cuts. But we are seeing, sort of that correct balance. Some countries are going to start seeing sort of modestly expansionary positions, Dubai, Qatar, to support the World Cup. But also in the case of Saudi Arabia, where the government is going to reduce central government spending, that's going to be compensated by the PIF. I think, one thing that's very, very clear on the ground, speaking to policymakers across the region, is how are we going to sort of move forward? It's not only the pandemic that created a big wake-up call, but it's also the energy transition. So I think, this is really speeding up policy reforms. Robert, you had mentioned the VAT increases in Saudi, now in Bahrain. We're seeing the announcement of corporate tax in the UAE as well. But I think also, there's the focus on how can the region be leaders in the energy transition, focusing on solar, focusing on the hydrogen industry. And I think, this is, since being in this region for over 20 years, looking at the region for over 20 years, I think, the policy-making backdrop is some of the most dynamic that I've seen. We're not going back to, at least so far. There's still challenges. I think there's still the balancing of the social side with the tighter fiscal policy. We've seen some sort of modest fiscal sort of slippage, whether it's to limit the price rise, fuel price rises on households in Saudi and Oman, some slower subsidy implementations of planned reforms. But these are relatively contained. But going forward, I think the key challenges are on the labor market front, creating sufficient jobs, having a labor market that meets the requirements of the future economy. So I think those are going to be critical points for FDI, for development of new sectors. And I think, that's also going to be balanced, going forward, if we do assume a sort of energy transition, lower energy demand. It's going to be very important to have progress with the transformation. And there's still a lot of uncertainty, especially related to more sort of high-tech, knowledge-based sectors as well. So I think, very strong position, positive signs on reforms, still uncertainties of the longer-term transition, but we're seeing a focus on that, which is very positive.
Thank you for that, Monica. I'm just going to ask one or two follow-up questions to both of you, and then we'll turn over to the audience, as we already have a number of questions coming in. But before we head over to the audience, I'm going to move to Erik first and pick up on some of the uncertainty and risks that you mentioned, and ask you to elaborate a little bit more on that. And then I'll come in and ask Monica about her take on inflation. So the first question, I'll ask them both. The first question over to you, Erik, is, you mentioned briefly in your comments the uncertainties. It's a highly uncertain world. And also some of the risks. But what is the IMF most concerned about in terms of those uncertainties and risks looking ahead? And how do you believe, or what's your assessment for how GCC governments are preparing for this uncertainty and risk? So that's for you, Erik. For Monica, we hear a great deal about inflationary pressure here in the US. Erik mentioned that for the time being, inflation hasn't been a huge concern in the GCC. But what do you think about things? Do you think the situation will stay that way? What can we expect in the future in terms of inflation? So let's maybe start with Erik, and then we'll move over to Monica.
Yeah. So thank you. Yeah. Yes. Risk and uncertainties. So yeah, we seem to agree that it's a fairly optimistic and positive picture that is emerging for the region for various reasons, which I'm not going to repeat. But at the same time, of course, the level of uncertainty and risks in the world and thereby in the region are at very high levels. They are still very high levels, and you have to start with we are still in a COVID pandemic, and we are still in a surge due to the Omicron. So therefore, one clear downside risk is clearly the future development of COVID. And it's extremely hard to predict, as we all know from personal and professional experience the last couple of years. It's very hard to predict what's going to happen. So we need to be careful about that. So I would say uncertainty as much as risk in that sense. And of course, I want to mention that it's very good at but generally GCC countries have a very good vaccination rate, and that put them in a very good position to handle whatever is going to come in terms of new waves of whatever is transpiring. Having said that, of course, if there are setbacks globally on the pandemic front, then that will have severe impact that could have significant impact on the global economy and the global financial conditions, which then in turn will have negative impact on the GCC. And I guess there are some other also. I think the main risks in a sense seem to be global, because as we were saying, as Monica was mentioning, they're going into a situation here. If current oil prices stay where they are, the region look like to be in a very, very strong position. But we also know from past experience that oil prices are uncertain and tend to be quite volatile. You can just look at the chart and you don't have to say much more than that. So therefore, that is clear. Right now, there are all kinds of indications that oil prices are high, and many experts are saying that they will continue go. There are even upside risks and so on and so forth. However, there is clearly a risk of oil prices going down again. And there is also the medium to long-term pressure that is likely to come due to the mitigation efforts taken by countries to address climate change over the future. Then I want to also mention, of course, like I mentioned before, there are concerns about inflation, which Monica will talk more about. But then that also spills into an uncertainty about the effects of what likely is going to be tightening of monetary policy stance in the rest of the world, or in advanced in the largest countries in the world, which will then have could have some effect on financial stability. It will affect capital flows, and it could also affect the access to finance for budgets. And that is another risk that needs to be addressed. And on your point on how prepared GCC countries are, we feel that they are quite well prepared in terms of their current policy trajectory, both on the fiscal front, and also there is quite a bit of structural reform momentum, as have been mentioned. So in this regard, it's very important to stay on track and continue having solid fiscal policies and frameworks, and also structural reforms, because those who have that, they will also be the best place to handle any shocks that might occur in the next few months or so, or even beyond that. So I think I stop there.
Thank you, Erik. Over to you, Monica, on inflation.
Thank you very much. I think, of course, inflationary pressures are building in the region, and given that a lot of our goods are imported, global trends are feeding in. But we're seeing inflation on the whole in the region really driven by three main factors: food prices. Most of the GCC, the food is imported from overseas. Fuel prices are going up. That's reflecting in the costs as well. Second is, of course, transportation, and that's also reflecting the higher energy prices across the region. And if we look back to 2015 to 2017, you had quite a lot of liberalization in domestic fuel prices. So in a number of countries, they're set on a monthly basis. So those have gone up. You have seen Saudi, Qatar, and Oman creating some caps at the end of last year to limit the upside. So that's meaning that we're not having the full burden as in other parts of the countries, but still you're, with the low base, the rise that we've seen in sequential basis at the beginning of the year. But also what you're seeing is imported goods, again, for the factors that I'd mentioned, but the fact that we've got the US dollar pegs and the dollar has been quite strong this year, that has sort of helped to dampen some of the imported inflation as well. So the first two areas are fuel and food, global trends, but also we've seen sort of recreation and hospitality picking up as well. We've seen of course, in the UAE Expo creating a lot of demand there. We've seen hotel rates, room rates, occupancy rates going up to levels seen before the pandemic, above seasonal trend levels. Of course, those will come off post-pandemic. They will get some support from the World Cup. So, as the economy's opened, as we've hosted these events, we've seen those areas. But unlike areas such as the US and Eurozone, we're not seeing it sort of spread out much beyond that. In the US, you're having tightness in the labor market. The GCC benefits from the fact that we can import labor as the demand comes in, and we've seen that influx as the cyclical recoveries happened in the real economy. We've seen people coming back in, so that reduces some of the upward wage pressure. So we do think that it'll be stronger in the first half of the year. Second half of the year, based on our assumptions that oil prices will moderate in the second half of the year from the first half of the year, we do expect to see some stabilization. The other fact is also that utility prices are set by in most cases, so that's not feeding into wider parts of the economy. We still have oversupply in housing, and so, for example, in the UAE, you've still got inflation in the low 2 digits, 2%. So 2.1%, 2.3%. is our expectation for the UAE for this year. So I think they're contained. I think for corporates, it's more of a worry, especially in competitive environments where it can't be passed on. We've had corporates absorbing it. But I think, I don't think that this is going to be the key concern unless we have a further significant move up in food and fuel prices. I think, the wider secondary impact has been quite contained.
Great. Thank you, Monica. We have a question, a hand raised by the chairman of our board, Ambassador Frank Wisner. So I believe he is queued up, and let's see if we can get him on here to ask a question.
Thank you, Robert, very much. I hope I'm coming through.
Yes, you are.
I am. Let me thank you and Monica and Erik for a really superb presentation. There are a couple of risks out there that I'm sure you would acknowledge more on the political security front, with ongoing civil wars or near civil wars in Yemen and Iraq. But the confrontation with Iran, while it is abated a bit, tensions remain nonetheless really very high and have an economic overhang. But I'm sure your calculations have taken those into account. I'd really like to ask you two questions that are related. One is the inflow of foreign investment. Some areas like NEOM in Saudi Arabia are planning on significant foreign investment flows to assist in transformation. And then there's the issue of Chinese investment. Where is it headed? So if you could say a word or two about foreign investment prospects for 2022, I'd be very grateful. And I'd be very grateful as well for impact in reverse of the ability of the Gulf to export capital to needy countries like Tunisia and Jordan and Lebanon, but also to fill out commitments to Turkey and other places that investment funds have been promised. The certainty of those flows continuing. That's a rather long comment and questions, but thank you so much.
Thank you, Ambassador Wisner. Erik, Monica, would one of you like to go first? There are a few questions there, so maybe what you would feel most comfortable moving forward with. Does either one want to take the lead there?
Well, I can start talking a little bit about foreign direct investment. And as it stands, the foreign direct investment in the region is generally not that high, and it definitely could definitely much higher. And for instance, you mentioned Saudi Arabia. It's part of their strategy for creating non-oil growth, and their whole vision 2030. A key part of that is to attract foreign direct investment. So I think there's a lot of potential to attract foreign direct investment. But in terms of that, we think that there are some key reforms that need to be put in place to attract. It is to continue labor market reform, to make movement between different sectors, also for foreign workers, even easier, and make sure that those reforms are implemented and followed through. Same thing, we have the untapped potential of the female labor force participation, which encouragingly has increased in the last few years, and have been encouraging reforms in a number of areas there. But that's another area where it needs to continue. We also believe that education reform and continued investment in education can be a very important part for attract foreign investment, because when foreign direct investments are choosing where to invest, one key element in choosing if and where one should invest is to look at can I get enough skilled staff to work, or employment workers to work for my company when I invest there. And that goes both in terms of the nationals who are already there, but also in terms of if you can have skilled workers coming in from abroad, which is part of the concept from many of the GCC countries. And also another area for reform is, of course, business environment, where I cannot, that depends from country to country and sector to sector, but there's a lot going on in making it easier to start a business and to open a foreign direct investment operation in a country, which right now, sometimes they could be a little bit of a hurdle, but there the reform momentum is clearly ongoing, and that is essential to continue. I do not have anything in terms of outward in foreign direct investments. I think that is something that definitely can happen, but I cannot say if they would how exactly what you would do to attract foreign direct investments in certain countries from the GCC region. I would say that well, the flip side of that is if you want to, there is clearly a lot of investment coming out of the GCC. And if you want to attract investment from the GCC, obviously, then you will have an attractive investment environment and business environment in those countries. So I think that's clearly potential, but I don't have any specifics on the specific countries. I think I'll stop there on this one.
If I could add to that, Robert, I think, for Saudi Arabia, they're still very underfunded for their transformation plan, just given the significant and huge size of it. FDI remains vital on many different levels, both on the construction side, key parts of infrastructure, energy, all of that side, but also then a lot of these economic cities, NEOM, will need foreign investors to come in to populate it, to bring businesses. I think, FDI has increased at a much slower pace than Saudi Arabia would have wanted it or had outlined it at the beginning of its transformation program. I see more FDI coming in related to PIF projects, rather than, again, coming in as a standalone greenfield investment, which ultimately is what Saudi Arabia will need for job creation, for diversifying the economy as well. So I think, again, that goes back to Erik's points. I know when we speak to different corporates about the region, again, a big concern is the efficiency of the labor force, and despite the reforms, again, as to add to what Erik had said, that it still perhaps is not as easy as it perhaps looks on paper. So still more has to be done on that. There's the issue also of payments from the governments and arrears and so on. So I think, still more work has to be done. What we saw after the last sort of economic boom of 2000, really from 2006 to 2008, etc., is that as the government sort of moved away from its investment program, FDI fell as well. So I think, you will see investment picking up in the next few years as momentum of the investment program comes down. But there's still a lot of question how much of that is permanent versus how much is that for the construction phase. And that's where we feel the focus is really going to be in the shorter term. On the outward investment side, I think, a lot of it is also going to be linked to the strategic development going forward. So, Saudi Arabia has taken opportune times when there's stock market corrections to buy equities, and that really reflects the PIF in the fact that not only is it a development fund, but it's also a sovereign wealth fund as well. So we've seen sort of purchasing on that side, but a lot of the investment, whether it's Saudi Arabia or the UAE, is now investments going into sectors that they want to develop and hopefully bring the technology back, bring the investment back on that side. So I think it's going to be far more strategic and far more linked to the longer and medium term development plans. And we've seen that in Saudi, whether it's for Lucid or for the clean energy program. And I think, again, sort of like Turkey, the investment on that side, we've had some announcement from the UAE. Again, it's to see where there could be synergies, where the market is seeing Turkey being punished for the the loose monetary policy and taking advantage of that. On the issue on China, I think especially for countries like Oman, particularly Oman, I feel in the region, where the fiscal position is still tighter, the market needs to see more fiscal reforms. Even if oil prices remain high, there needs to be continuity both for Oman and Bahrain. I think Chinese investment has been critical, and that's been also on the other side, where a big destination for Oman's energy has been China, and we've seen a lot of investment coming in to Oman on that side. Bahrain not so much, because it's mostly GCC investment, and I think it'll stay that way. But I think for Oman, it's really been critical to have that Chinese link. So that sort of fits in also with the fiscal side, who needs to be more dependent on FDI than on the other side. Thank you.
Thank you, Monica. I'll just add on to that, because I was looking at cumulative Chinese investments and the value of construction projects in the Gulf for a piece that I'm writing right now from early 2000, I think 2001 to 2021. And the breakdown of Chinese investments across the region is roughly proportional to the size of these economies. So as we would expect, Saudi Arabia, I think, accounted for 43 billion or so of cumulative investments, according to this tracker, in about 2 decades. And then, as Monica said, moved down the line. Bahrain had around 1 or 1.4 billion. I mean, a small fraction of that. We saw it moving from Saudi to the UAE to Iraq. One of the outliers is actually Iran. I mean, if you look at the cumulative investments, Iran received about 23 billion over that time, the same time period, which is even less than Iraq. So I think many of us on this call know a lot of the barriers, investment barriers, and other challenges that I think stem some of those flows. But that's just a quick answer. And a follow on too about Oman, as Monica rightly said, so much of the oil shipments coming out of Oman are destined for China. As of 2021, it was about 83% of those exports were destined for China. So there is that significant indirect fiscal dependency on China as an energy consumer. Let's now pivot to some of the questions. We have about 12 minutes. Preciously narrow window to answer all of these questions. So I might ask for everyone to do their best to keep the answers short, and we'll try to make our way through as many of these attendees' questions as possible. The first is a quick hitting question. It was, should and will Bahrain introduce a corporate income tax similar to the UAE? I believe it's one of the only countries to not have some form of corporate income tax. And are you concerned about the delays in Oman's consolidation plans? In specific, they're mentioning subsidy reform and launching personal income tax. So over to Erik and then to Monica.
Yeah, so on Bahrain, I do not want to comment on specific detailed policies in specific countries, because these are countries where there's ongoing policy dialogues right now. But we think generally we are in favor of broadening the tax base for countries, precisely for the reason that I mentioned before, because in the past we have had a very clear pattern of fiscal policy being pro-cyclical, i.e. when oil prices go up, spending have been going up, and when oil prices have been going down, then there have been jump on the brake to stop doing it. So that I don't want to go further into that. And the same thing applies to Man on the detailed question on the spending reforms there. But we are, as I say, we are definitely in favor of we think that fiscal consolidation of the medium term is essential, and it's essential to have credible and well communicated plans for fiscal consolidation and fiscal policy. And I think that's a broader sense that also goes back to the previous point on FDI and the role of sovereign wealth fund, is that fiscal transparency is going to be at the premium going forward. Because if you can show what you're doing on the whole fiscal balance sheet, not including only central government, but also including what other government entities are doing, that will help a lot to attract investment and also communicate that where you are in your fiscal policy strategy. So, thank you.
Monica, would you like to follow up, or do you on corporate income tax in Bahrain? Over to you.
Yes, I mean, I think absolutely they should. I think that's going to be a key part of the reform program, and especially if we see the OECD developments and the fact that part of the tax will be paid in the home country. I think it'll be highly beneficial, and especially given the fact that Bahrain is a more diversified economy, and they should be earning revenue on this through income tax. On the case of Oman, and really I think for the wider Gulf, I think a lot of the medium-term fiscal plans are very ambitious, and Bahrain's as well, especially for 2023, if we look at the level of consolidation that it looks to have. And I think, when we do our forecasts, you always assume that, okay, that it's not going to be an even pace of implementation, because the economy has to absorb it, the people have to absorb it. So, I think it's always going to be a bit slower. I think what's important is the consistency. With oil prices where they are, or even if they're a bit lower, we still think there's space for some modest slippage, but going forward, what you need to see is sort of a longer term ongoing momentum with it.
Okay, thank you. Ambassador Wisner and a number of the audience members asked questions or referred to the ongoing conflicts in the region and the prospects for continued tensions. I guess to try to subsume these questions into one, how, Erik, at the IMF and Monica, being based in the region, are you factoring in these ongoing conflicts in the region, and also the prospects for acute shocks and other types of disruptions and tensions? How are you factoring those dynamics into your forecasts over the medium and longer terms for economic growth? One of the audience members mentioned, can we discern any economic ripples from some of the conflict and incidents that we've seen of late? I think it's probably pretty early to do a really in-depth analysis on that, but would be curious in how you're thinking through these issues in terms of forecasting. So maybe, Erik, would you like to start?
Sure. So, as you say, at this point, I did not mention global tensions, but that is clearly something that I and the IMF in the latest World Economic Outlook update in January is mentioning as a clear problem. I do not think, for the reason that we see clear major impact on the region so far, in just that there are potential. Of course, there is some things going on as well, but in terms of actual conflicts getting deeper and even more concrete, we don't see much of an impact. But how do we take this into consideration? Well, we do not have this in our baseline, a major conflict, of course. However, we are doing scenarios all the time, downside scenarios, and that depends from country team to country team, and sometimes we also do regional or even global scenarios. And this is something we definitely are looking at. And this also includes, of course, if there could be disruption to trade, including on export of food and so on and so forth. So that's what we're doing. But in terms of preparing, that's of course exactly why we have that's a key part of our policy dialogue with countries all the time. And I'm not going to say it again, but I want to get back to that. This really is a very, very good opportunity for these countries to have to build on this reform momentum. I agree. The fiscal plans are quite ambitious, pretty much across the board, and the reform momentum on the structural front is also quite strong. And this is very important to keep on going. And I will add which is sometimes is forgotten these days. But we have a situation where the financial sector could be vulnerable. I don't think they are. They look sound as they are. But in terms of having past policy support might have masked some vulnerabilities that exist there. So it's also very important for financial oversight, for financial sector supervisors to be very vigilant and to make the countries prepared if there are shocks, because there, as we can see, there are many shocks that are possible going forward.
I think from our point of view, it's even when it comes to the basics of sort of forecasting the oil price, the geopolitical tensions that we're seeing, just make it very, very hard, which is, the cornerstone of where we start for the Gulf. On a fundamental basis, our forecast is for 75, but it's very hard to know when, event happens and oil prices go up, whether it's Russia and Ukraine or elsewhere, or at the same time, if an agreement is made on the nuclear side with Iran, and then you have new supply coming in. So you see upside and downside, on the forecasts. As Erik mentioned, that there have been sort of some events, in the region as well. But what we found, speaking to investors who we speak to, whether they're sort of fund managers or corporates looking to invest, so far what's really been the area of interest is the reforms that we're seeing, is the IPOs, is the fact that you're seeing strong oil prices. Even on a fixed income side, the fact that we've got the US pegs to the dollar at the time when the Fed is looking to raise rates and there's more uncertainty of other emerging market countries, we found those discussions being more the core focus, and maybe sort of geopolitical side coming at the end. So at least for capital inflows, at the moment, the focus is really on the reforms, on the oil price, on the currency, and those areas.
Great. One point we haven't covered yet, and I'd like to close out the discussion today, is looking at labor markets in a little bit more depth. I mean, I mentioned this from the beginning as one of the major issues facing the region. Monica, you made some references to that, to the labor market in your comments as well. And a number of the audience members have also asked about this. So, and this really, labor market dynamics are part of efforts to attract FDI and a whole host of other issues that we've talked about today. So I guess in the last couple of minutes, I'll turn it over to Erik and to Monica. I mean, what is the outlook for Gulf labor markets? Where are the areas where there's some cause for concern? And are regional governments doing enough to create the number, the quantity, and the quality of jobs needed for not only for their citizens, but also for the expatriate residents who they hope to attract over the coming decades? So maybe we'll start with Erik.
Yeah, okay. So I think there have been good reforms on the labor market. And I think one key aspect, as I think I mentioned before, it is to have legislation in place and being implemented that allows non-nationals to freely move between sectors, and also that the national and non-national labor market is more integrated, and thereby create incentives for nationals to participate in all parts of the labor market, and thereby having a larger labor market for everyone, and also which will in turn attract investments. And then just another point, which I will emphasize again, the movement on female labor participation has been really encouraging the last few years. And I think, if anything, this momentum have been improved by COVID for various reasons, including the use of technology. But I think that is also an area where we are really looking forward to have the reform momentum continuing. So I think those are two main issues on the labor market.
I agree 100% with that, but I think it's also very, very different. And I think this is where the individual cases of the GCC countries really come out. Just starting off close to home in the UAE, labour reform has been a big part of the key pillar of the transformation plan, whether it's for the visas, and we've seen that benefiting the real estate market. Just in February, the new labour market, the new labour reforms came into effect, and that really brings in flexibility to try and bring in more sort of different type of labour, more freelance labour into the region. So I think those are very positive. I think, you know, some of the smaller countries with higher hydrocarbon reserves, whether it's Qatar, whether it's the UAE, you know, their economies are such that the domestic labour force is too small to meet the requirements. So having this flexibility to bring foreign labour force in is very positive. In the case of Saudi Arabia, Oman and Bahrain, I think this is where there's challenges across the region for the labour market, but particularly more acute there. And I think, you know, that goes back to the balancing of creating the jobs versus the fiscal reforms. Pressure is on the private sector for employing nationals as well. So that's something that's been highlighted when we see the private sector across the region. And I think, you know, as I mentioned before, I think a lot of the private sector feedback is that, you know, both on the skills and the cost of the labour, there's a big difference between expatriate labour and domestic labour. And I think that's going to be a key bridge that has to narrow as well.
Okay, well, with that, we are over our allotted time. I want to thank everyone who contributed questions. We have, unfortunately, many that we were not able to get to, but it did help with a very vibrant discussion. So apologies for not getting to all those questions. We hope that you join us again, and we will try to get to those at the next event, which hopefully will be very soon. And also, Erik and Monica, it's a real pleasure having you with us today, and appreciate your insights and your comments.